very warm welcome to you on Business Today television in our ongoing series of Market Gurus, where you get to meet the finest investors and fund managers on the Lal Street. It's our pleasure to host Mr. Pankaj Tibrewal, founder and chief investment officer at the newly set up Ikigai Asset Manager. Mr. Tibrewal has previously worked with Kotak Mahindra Mutual Fund for a span of about 13 years, and before that he was a part of the startup team at Principal Mutual Fund, where he spent 6 years. Ikigai, as we all know, is a Japanese term which essentially means that you get to do what you like, and a need of something that is there in the market, and if you can get paid for it, then nothing like it. Mr. Tibrewal sits bang in the center of Ikigai and is a wonderful stock picker. Namaste Pankaj ji, what a warm way to welcome you in a market which is consolidating near record highs. Share with us your thoughts about sentiment on the Lal Street after a cracker of a GDP number that's come in.
So, thank you for inviting me and being part of your channel. If you look at markets have hit all-time highs, but somewhere the happiness is not there among market participants because portfolio is not reflecting the all-time high figures. And the reason is as follows, that if you look at the breadth of the market has been one of the worst breadth we have seen in the last many years. And clearly, if I look indices by indices, though Nifty is at all-time high, but the median return of the Nifty is about 8-9% lower. Similarly, if you look at the mid and small cap indices, though they are small cap indices is 7-8% away from all-time high, but the median constituent return is about almost 20% lower than the 52-week high. And similarly, on the BSE 500, if you look at, the index is about 4% away from all-time highs, but the median return is about 18% lower. So the breadth of the market has not been very conducive, and that's reflected in overall returns of the portfolios. And if you look at the Nifty, it's been driven by few handful stocks, which has taken the Nifty higher. So I think as the GDP expands, as the earnings momentum in the second quarter we saw was much better, I think you will see that breadth of the market improving, and hence companies which will deliver strong growth will probably be chased by the street. So clearly growth is something which people want, and that's what will be reflected as we move ahead.
Right. Pankaj ji, of course, ladies and gentlemen, manages 3,500 crore rupees in a single offering at Ikigai PMS, which is the mid-cap and the small-cap fund. Between 45 to 50 stocks is where 3,500 crore rupees is invested. Pankaj ji, as you very rightly mentioned that the record high is only on the Nifty, and there is pain all around, especially in the mid-cap and the small-cap space. Are there any signs, any green shoots, any thought processes that come from third quarter, second quarter earnings, where you hope that this rally will seep or percolate into the lower rung, the mid and the small cap? It's been a trying 18 months for investors in PMS, in mid and small cap funds on the mutual fund side as well.
Yeah, absolutely. If you look at the earnings for the top 500 companies, the earnings for top 500 companies in the second quarter was a growth of 15%. This was after a long time that we saw a double-digit earnings growth. Double-digit earnings growth. And if I decode it into three market caps, which is the top 100 companies, which is large cap, the earnings grew by about 9%. Then comes the next 150 stocks, which is the mid cap. That earnings grew by almost 31%. And then is the next 250 stocks, which is the small caps. The earnings grew by about 36%. But let me just put a caveat there. A large part of this earnings growth in mid and small cap was driven by very strong results from OMCs, where in mid cap HPCL is a part, in small caps you have Chennai Refinery, MRPL, and so on, which had a stupendous growth. But even if you adjust for that, I think the earnings growth of mid and small cap was much higher than large caps. And this is not today. For the last four consecutive quarters, if you look at, mid caps have delivered better earnings growth than large cap. So I believe that sooner or later markets will take cognizance of that. And our sense is that it will not be a runaway rally which we saw in the last 4 years. Market is getting more and more selective, and hence market will only reward few winners rather than everybody. So I think it will be a great time from stock picking approach, that people who can pick right stocks from a right promoter, right balance sheet cash flows, I think will be the winners as you move ahead over the next couple of years. But I believe that yes, the consolidation has happened.
Okay.
Valuation adjustment is undergo. And slowly and gradually, once the earnings growth in the third and fourth quarter also support, I think you will see green shoots emerging.
Hmm. Okay. Pankaj, if you could just elaborate a little bit about the portfolio structure at Ikigai AMC. What is the concentration of top 10 stocks, mid or small, in terms of 3,500 crore rupees? And are there any sector overweights? For instance, do you prefer a particular sector? What would be the way the market capitalization is distributed over sectors?
So if you look at the overall portfolio, 90% of the portfolio is invested in mid and small cap segment as defined by AMFI. Okay, and that's the definition we also follow. And this is a roughly an equal distribution, about 43-44% between mid cap and about 44-45% between small cap. So that's roughly 90%. About 8-9% is large cap. Cash is about 2%. We don't take huge cash calls in the market, and that's been my style for a long period of time. Across, if you look at the portfolio is well diversified among stocks as well as sectors. The key overweights in the sector which we are running is auto and auto ancillaries. We believe that a new cycle has begun in four-wheelers, two-wheelers, tractors, and CVs. And we have been well positioned across
Okay.
auto ancillaries and stuff like that. The second sector where we are positive materially is chemicals. We believe that barring the near-term headwinds on trade tariff, I think India has the right to win on chemicals. And slowly and gradually, we believe that the China One Plus can see it light, because a lot of Indian manufacturers, especially on the specialty chemicals, are getting contracts from the innovators on agrochemicals and pharma. So I think chemicals is the another big piece. Uh, Banking, which is NBFC plus banking together, is another place where we are positive on. And we believe that the next year earnings growth for the market will be driven more by banking than any other sector. That's the third space. One of the contra calls which we have taken
Wonderful.
is in the metal and mining. We believe that the worst is behind us for metals and mining, and incrementally you should see metals and mining do well. And some portion is there in the industrial part, which is the power T&D space. We believe that the T&D spend has to continue over the next few years as you move ahead, because you need power for data centers and stuff, and for that you need transmission, which you need to connect the grid with the power producers. So I think that's how the portfolio is positioned as we speak.
Okay. I think it's a very eclectic mix of uh, quality stocks as well as sectors which will show earnings growth ahead of the Nifty, and maybe their own sectoral plays as well. Pankaj, the I would presume that at Kotak and at Principal, the main theme to would be to buy margin of safety, and of course look at valuation in terms of what growth can be, as also beaten down valuations. In this context, and with the background of a record low on the rupee, how are you looking at the IT space? Is there a representation in your mid and small cap portfolio of IT stocks?
Yes, we have been underweight on IT for a while, which has the call has played out quite well. Because if you look at the IT index, they have underperformed Nifty by a wide margin. But incrementally, we think that the worst is behind us, and our conversation with most of the IT companies suggest that the incremental deal conversion has started to happen. And we believe that over the next 2, 3 quarters, IT company growth could marginally surprise us on the positive side. So we are very selective on IT space, but there are few companies on mid and small caps and large caps, which probably is starting to appear well. And there will be a forex tailwind because rupee is almost at 90, so there will be a forex tailwind which will help these IT companies over the next 2, 3 quarters. So we are starting to again increase our weightage on IT sector, and we believe that this could be a better time to do that.
And what would be your preference in IT? Yes, this is a mid cap and a small cap portfolio at Ikigai, but where is the valuation matrix skewed in favor of possibly medium term returns which might outperform the Nifty?
So if you look at from an IT perspective, last 3, 4 years, certain mid-cap stocks have clearly driven growth. Large caps have struggled on growth because of the base and because of the Gen AI impact also on the business. So I think that view remains, that most of the large cap companies will deliver between 3 to 5% growth, not more than that. But there are certain mid cap companies which are offering double digit growth. And hence, though on valuation they may look a little expensive, but finally growth is something we need to be aware of. And I think in certain pockets in the mid cap IT, growth is still visible. And hence, we will prefer few of the names in the mid cap space and in a couple of names in large cap where we believe that the growth incrementally can move to about a double digit number.
Hmm. Okay, so that's something that should be of comfort to long-term shareholders of IT stocks. Pankaj, how are you treating the Indian digital space? There has been some listings that have given decent returns, and there have been some old timers such as car trade, etc., that have come back with a vengeance on the price front as also on their financial front. What is the allocation to the digital space at your portfolio?
So this is a new space and we are incrementally increasing our weightage provided we understand the business model. See, you have to accept the fact that what led to the 4 trillion, $4.5 trillion economy and the sectors which did well, 4.5 to 10 trillion economy, the winners could be very, very different. Nobody could have thought about that company Eternal, which got listed few years back, will be part of Nifty in a very short period of time. So those are the changes which are reflective of our daily habits, needs, and stuff like that. And clearly, many market companies are reflecting that. That should be part of our representation. But don't forget that many companies are discovering their valuation metrics. Markets is also learning about them because they have not been in existence for too long. And only worry which I have from a overall that business models are great, they are scaling up well. At some point, they will start making a lot of money. The power of platform is amazing. They are capturing the new India. But only thing which I worry about is that most of the founders in many of these listed digital companies have a very small skill in the game. The stakes are very low. Most of them are owned by P funds or institutional funds and stuff like that. And after maybe 3, 5 years, if they get tired and decide to sell off, uh, who will manage, who will drive the business is something which don't have an answer today. It may not happen also, it may happen also, we don't know. But this is one risk which we need to be aware of, that the supervision of these companies could be a challenge as you move ahead. Because finally, India has still not evolved that where the board will manage the business, board will drive the business, which happens in US or other parts of the world. So I think that's one risk we need to keep in mind. Otherwise, there are many unique business models which are disrupting the old legacy businesses. And I think we need to be open-minded in evaluation and taking some portion as part of our portfolios. And we are positive on that.
Okay. Uh, Pankaj, I wanted to ask a fundamental question that is bothering the market in general. We've had a headline GDP growth of 8.2%, but the market seems unconvinced about the way the data is structured, the way the deflator is working, and the way how the inflation rate has been represented. Are you amongst the naysayers? Is this a data point that worries you?
No, so I think obviously what we look at is real GDP growth. I think nominal GDP growth is real plus inflation. Inflation in India, the deflator has been extremely low for a while now. And country like India, we need some kind of inflation both from a corporate earnings growth as well as from a growth perspective overall of the economy. So I think that has been subdued. So there is not much difference between the real GDP and the nominal GDP growth rate, and hence market is a little bit not convinced on this. But broadly, if you look at the breakup, clearly consumption is on a revival. Capex continues to be reasonably good. And I think there's no reason for us to believe the GVA growth has been about 8.1%. And I think broadly, I think I am okay with the numbers. Just that now a bit of inflation needs to be catching up so that our nominal GDP growth also moves into double digit. Because don't forget that most of the earnings, the estimate by the government on budget, everything is not done on real GDP but nominal GDP growth rates.
Okay, fair point. Any space that you're avoiding where second quarter, third quarter earnings fell short of expectations, something that the valuation matrix still doesn't throw up quality stocks available at reasonable prices? What is the sector, the stocks that you are avoiding at Ikigai?
So rather than sectors, I would say that we should be very aware of two, three things. One, I think there are a lot of narratives which are driving the stock prices. But when I look at the hygiene of the earnings and the earnings quality, that's not giving me comfort. Many sectors, we are seeing that only people are chasing the profit, accounting profit numbers. But when you look at the balance sheet and cash flow, it is not giving you comfort that the 5 years operating cash flow is zero. And the entire growth is getting funded by equity capital raise or debt, which is never a sustainable business model in the long run. And we saw that in 2003 to 8, that a lot of power companies, infra companies, real estate companies, this was the same playbook, that keep raising capital from the markets, keep funding it through debt, don't worry about cash flows. And one bad cycle, those companies are vanished. I think we should be aware of those narrative in many sectors on a bottom-up basis. And I think I'm fearing that kind of mistakes being done by most market participants right now. So I think that's the area where I'll be a little careful on. And it's in EMS space, it's in renewal space, it's in many of the new, areas which are sunrise, so-called sunrise sectors. That the hygiene on accounting quality and basics which should be followed is not there. So I think that's a area of worry for me. Apart from that, I think anything which is very high on valuations, though in the near term there is earnings momentum, but longer term, if you look at, if these are not driven by sound, sustainable earnings growth, I think there could be a challenge. So be very careful on what price you are paying to enter into the stocks. I think there could be a lot of disappointments there as well. So I think these are the broader thoughts I have on what to avoid. I won't say any sector is a big avoid, but on a bottom-up basis, be very aware of the narratives and what balance sheet and cash flows one is buying into.
Okay. Pankaj, this Japanese 10-year bond yield and the 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 yen carry trade problem regularly surfaces on Indian markets. At the moment, the Japanese 10-year yield is what we saw in 2007 2008. Is this a risk that the Indian markets are facing, which may result in a further pain on major indices? How are you looking at it? Is it temporary?
I think it's a global market financial risk. So the world has been used to borrowing in yen and lending elsewhere wherever the returns were, when the bond yield was virtually zero. Now the bond yields have gone up very, very sharply. That means that all the yen carry trade which people were carrying have to be unwound. That could be a painful process for the world financial markets, in my view. How it happens, when it happens, is anybody's guess. But I think this risk should not be ignored from a longer term perspective, because now the 10-year bond yield in Japan is up by almost 300 basis points. And that's not a small number, because you were borrowing at 0% and lending in the world. Now that yield has gone up very, very substantially. So I think there is a risk of yen carry trade getting unwind, and market participants should be aware of that.
Oh, fair point. That's a very sensible and a practical way to also look at the global risk on trade. We might presume that a lot of speculative assets are actually rising on real demand, but the fact remains that they have been funded by cheap, almost inexpensive, almost zero money from Japan, and because borrowing costs are rising in Japan and that money has to be returned, therefore you see this very strong unwinding that's happening in the AI trade, in the Nasdaq and the Dow, as also in Bitcoin. Remember, Bitcoin was something at $120,000 per unit, and at this point of time, I think the last time I checked, it was 86. Let me just check this again. Yes, $86,975 to a single Bitcoin, and somewhere in October 2025, this was at $1,25,753 per unit. So that's the kind of sell-off that's happened in speculative assets. Be that as it may, something on the rupee front, Pankaj, that worries you? Is this a temporary phase? Do we see a reversal towards 88, or is 90 the new reality?
So I think clearly, I think from an export side, tariff has started to play a role. I think from a current account, we saw that the last declared numbers, that gold imports were a huge number. So clearly, current account was not very good if you look at the recent numbers which got declared. And also on export, we got hit on the tariff. I think sooner the resolution happens on tariff, many sectors like textiles, gems and jewelry, which have been hit very hard, and certain parts of pharma, chemicals, and others can resume their growth path again. I think once that happens, a large part of pressure on rupee starts to unwind itself. But I think on an overall basic front, I think government has done a fantastic job over the last decade, and the inflation differentials have come down substantially between us and US, which is a major determinant over a longer term in terms of rupee depreciation. Also, interest rate differential is one of the lowest at about 2%. So the 10-year bond yield in US is about 420. In India, it's about 640, 650. So I think that's where the bond differential is also. So it's a near-term phenomena in my view. We were also very surprised last week when a single day rupee, dipped by about 70 paisa in a single day. So I think that's something which probably we should not be reading too much right now. Hopefully the tariff resolution happens sooner than later, which takes off some pressure on export side and hence on rupee.
Okay. A couple of last questions, Pankaj. Given the macro tailwinds which are boosting markets, as also very strong retail flows into the mutual fund sector, what according to you would be a sensible level of the Nifty somewhere like mid 2026?
To give a number is always a very difficult one, but we believe that the earnings growth should start resuming. And we have seen the early signs in the second quarter, third, fourth quarter should also be better. And hence, if we see a earnings growth revival, I think Nifty should clearly follow that direction, and the broader market should also follow that direction. So India has underperformed emerging markets and the world market by a massive number this year. We are up 5-6% year to date. The world, like for example, South Korea, Greece, Germany, European parts, uh, China, all are up by 25% to 50-60%. And we have underperformed emerging market by 24-25%. So our hunch is that once earnings growth consistency is shown, uh, certain government policies have also started getting unveiled, the labor laws and stuff like that. I think markets will take a confidence on that and move towards it towards the 26. I think the downside is limited in the market, barring some global events which it happens. But the upside, once the earnings starts to resume on a double-digit front, I think, and FI flows resuming, I think you should see market moving higher from here on.
Right. And I have deliberately kept this question at the last, Pankajji. It reflects the kind of anxiety that people are living through, which is, are we in a pseudo bear market with a very narrow bull market limited to the Nifty seen on Dalal Street? Is this something that will get worse from here?
My sense is that it's a consolidation phase, and that consolidation has also almost lasted for 15-16 months now. The answer will lie that whichever bear market in broader market we saw, let's go to 2018-19. Only Nifty was hanging along, and if you remember, Ritik was the word where 6 stocks in the Nifty was taking the Nifty higher, but there was a bloodbath on the broader market side, and especially in the mid and small cap segment, which corrected very sharply because there was a solvency risk, which was emerging. Every day you heard about Vakrangi, DHFL, there was ILNFS squeeze, and every day there was something other which news which was coming out, and market was very worried on that side. I think that worry this time is not there because the balance sheet of corporate India, and especially the mid and small cap segment, is in a very, very strong position. And I don't think that when there is no solvency, there's less risk of solvency, you should see a crash. Yes, there is a certain amount of consolidation happening, and there is a lot of supply of new paper, which is happening in this segment, which is especially small cap and mid cap, between 5,000 crore to 20-25,000 crores. So ideally, that money which should have actually found itself into the secondary markets is getting absorbed by the primary market. So I think that's two main reason, and I think valuation, a little bit of correction is happening. We saw a huge run up in this segment over the last 3-4 years. That valuation adjustment is taking place. But will I say that we should all go and sell off all these segments and just move to few names in the Nifty? Answer is no. It could be a shorter term phenomena. But over the next 2-3 year perspective, most of the growing sectors of India and most of the new sectors of India are represented by mid and small cap rather than the large caps.
Right. On that optimistic but cautious note, Pankajji, let's call it a day. Thank you for coming. And as always, it's a wonderful learning exercise, understanding what Ikigai means on Dalal Street. Here's wishing you all the best and a happy new year ahead for you.
Thank you,
everybody investing at Ikigai.
Wish you, you and your viewers and your team a very, very happy new year and happy 2026. See you in New Year very soon.
Okay.
Thank you.
Yes, we'll be meeting shortly. Thank you, ladies and gentlemen. That was Mr. Pankaj Tibrewal, CIO and founder at Ikigai Asset and Management Company. Mr. Tibrewal manages 3,500 crore rupees spread over 45 to 50 mid caps, has an overweight position in autos, auto ancillaries, banks in particular, has a smattering of position in the digital space and some in the IT space too. Thank you for watching. I'll be back at 2 p.m. to take forward another interesting interview with a top market personality. Thank you for watching. Please continue with Business Today Television. Good afternoon, ladies and